Hello, and a very warm welcome to this webinar on sustainable finance from Shepherd and Wedderburn. I'm delighted you're able to join us today. My name is Peter Alderdice, and I'm a director in our banking and finance team. I'm joined today by my colleagues Tim Davidson and Matt Minuczyc. This webinar is the third installment in a series of webinars on environmental, social, and governance topics. In the first installment in our series, What Does ESG Mean for Your Business? Louisa Knox and Gordon Downey, who lead Shepherd and Wedderburn's ESG advisory group, discussed the three pillars of ESG and the main challenges that ESG poses to businesses. Our partnership chair, Gillian Carty, also gave an overview of Shepherd and Wedderburn's own ESG journey to date, and discussed what progress is still to be made. In the second instalment, ESG litigation and reputation management, Matt Phillip, a partner in our commercial disputes team, was joined by special guests Jack Naylor, Chief Investment Officer and Head of Origination at Aristata Capital, and Andy McIver, founder of Message Matters. Together, they provided a very insightful overview of ESG claims, the role of litigation, and reputation management. If you missed either of those webinars, you can find them on demand on our firm's YouTube channel. Go to Shepherd and Wedderburn on YouTube and click on the ESG webinar series there. In this third installment in the series, we're discussing ESG and sustainable finance. While ESG has a wider relevance in our retail financial markets too, our particular focus today is the loan market in the UK for corporate loans, including syndicated lending. Today's webinar is in two parts. In the first part, my colleague Tim, an associate in our banking and finance team, will discuss the various transparency regimes in the UK that have an impact on loan financing transactions. Transparency is an important aspect of governance. That's the G in ESG. It's an area that has often received less attention, but opaque ownership structures and improper control of real estate and corporate entities have become hot topics recently, particularly with the passing of the new Economic Crime Acts by the Westminster Parliament. The second half of our session today will look at the E and the S in ESG as we consider the rise of green, social, and sustainability-linked lending in the UK. Matt, who's a banking and finance solicitor in our London office, will share his thoughts on three industry frameworks for ESG lending, which have been published by the Loan Market Association, namely the Green Loan Principles, the Social Loan Principles, and the Sustainability-Linked Loan Principles. Matt will explain how each of those frameworks works and how lenders and borrowers can use them to achieve their ESG objectives. We hope to have a little time at the end of today's webinar for questions and answers. You can use the Q&A function at any time during the webinar to submit a question, and we'll try to get through as many of them as we can towards the end of the session. Now, let me hand you over to Tim, who will kick off our webinar with a discussion of the transparency regimes that affect corporate loan transactions in the UK. Tim.
Thanks, Peter. So as Peter mentioned, I'm going to run through the key transparency regimes which apply across the UK and which need to be kept in mind both at the outset and throughout the duration of any financing transaction. In particular, I'm going to focus on registration requirements under the new UK Register of Overseas Entities, the National Security and Investment Act, and the Persons with Significant Control regime. For each of those three regimes, I'll try to broadly cover when and why did the regime come into existence, What are the obligations placed on companies by the various regimes? And finally, how do each of those three regimes impact on facility agreements or loan agreements and on kind of financing transactions as a whole? So kicking off with the Register of Overseas Entities. This regime was created pursuant to the Economic Crime, Transparency and Enforcement Act 2022, very snappily named, and provides for the creation of a new register of overseas entities, which is maintained by Companies House in the UK. The Act had been under discussion for some time due to concerns about a lack of transparency in respect of ownership of UK property by overseas entities, and also the potential use of UK properties to facilitate money laundering. So the first key question is what is an overseas entity for the purposes of this regime? And frankly, it's a relatively easy one to answer in that an overseas entity is quite simply a legal entity which is governed by the law of a country or territory outside of the United Kingdom. So what does the regime do? In simple terms, a new register of overseas entities has been created and is now currently maintained by Companies House in the UK. Overseas entities must register in the register in the following circumstances. So firstly, if an overseas entity either acquires or disposes of UK property on or after the 5th of September 2022, they are required to be registered in the register. And the land registration regimes, both north and south of the border, have now been updated so that if an overseas entity is not registered in the ROE, then any disposition or acquisition of a UK property will not be capable of registration at the relevant land registry. The second limb here is if an overseas entity holds UK property which was acquired before the 1st of August 2022, then that entity was required to register on the Register of Overseas Entities. There was a grace period here, so overseas entities which already owned UK property had a grace period which lasted until the 31st of January this year to register, but that period is obviously now past. So as of today's date, all overseas entities which owned UK property acquired before August 2022 should be registered in the register. And if they are not registered, they will be restricted from disposing of that property. So what do you actually have to do to comply with the regime? Firstly, an overseas entity seeking to apply for registration on the register must deliver an application to Companies House. That application includes fairly straightforward information about the entity, such as its name, its country of incorporation, and the details of any public register on which it's entered. Secondly, the application must include details of the registered beneficial owner of the overseas entity, and then similar information as is provided for the overseas entity must be provided in respect of the beneficial owner, so the country of incorporation and details of public registration. So that's the first obligation. You must register on the register. Secondly, once you are listed on the register, overseas entities have a legal obligation to keep that information up to date. Rather than that being an ongoing obligation, so an obligation that you have to comply with on a daily or weekly basis, entities instead have to file an annual update statement to Companies House. That update statement must either confirm that the information which is currently held remains correct, or it must update the details of the registered beneficial owners to reflect any changes in the ownership structure which have taken place in the preceding 12 months. So that's the regime, fairly straightforward. And the next question is how does that regime impact on financing transactions? Ultimately, the ROE regime is probably of greatest significance in the context of real estate finance transactions, as any overseas entity which has not registered on the register will be unable to dispose of or acquire any qualifying UK property. If a corporate borrower is an overseas entity and is either acquiring a UK property or granting a charge over it, then we now often see lenders requiring the relevant borrower to certify as a condition precedent that they have complied with their obligations under the relevant legislation, and to also provide evidence of their registration in the register. That's become a relatively standard inclusion on real estate finance transactions involving overseas entities, as any funders will require sufficient comfort that their borrower can acquire good title to the property which is being funded and can then grant fixed security over that property in favour of the lender or any security agent or security trustee. A lender would obviously not want to allow a situation to arise where a borrower drew down a facility to acquire a property only to then find that, a legal mortgage or a standard security cannot be registered at the relevant land registry, simply due to the fact that the entity is not registered on the ROE. Secondly, in terms of additional undertakings or covenants being included in facility agreements, that tends to be considered on a kind of deal-by-deal, case-by-case basis. In many cases, no additional drafting would be included on the basis that most facility agreements already include fairly broad covenants, such things as compliance with laws, which are often deemed sufficient to cover the borrower's compliance with its obligations under the ROE regime. In some cases, lenders may consider it prudent to include additional specific covenants in their facility agreement, covering compliance with the regime, and the Loan Markets Association, the LMA, have published some template wording which can be adopted here and which we have seen used on various transactions. So I'll now move on to the second regime, which I was intending to cover, which is the National Security and Investment Act, or the NSIA for short. The NSIA received royal assent in 2021, and from the 4th of January 2022, established a new statutory regime for government scrutiny of corporate acquisitions and investments. The new regime significantly expanded the UK government's ability to scrutinise these transactions for the purposes of protecting national security in the UK. Unlike the previous scrutiny regime, i.e. pre-NSIA, the government's ability to scrutinise transactions is no longer subject to a minimum turnover threshold, and similarly, it's no longer subject to a share of supply threshold. So essentially, there are now a broader net of transactions which are caught by the oversight regime and are potentially subject to government intervention and scrutiny. So what does the NSIA do? And I will try to keep this relatively brief, as it's a fairly complex system to explain. So essentially, the NSIA sets out a number of what are known as trigger events, which may be subject to government scrutiny. Trigger events can relate to control of either a qualifying entity on one hand, or a qualifying asset on the other. A qualifying entity is quite simply any entity which is not an individual, and it therefore includes UK companies and UK LLPs. An entity incorporated outside of the UK may also be a qualifying entity for the purposes of the NSI regime if it carries on activities in the UK or if it supplies goods or services to persons inside the UK. So those are qualifying entities. Qualifying assets, in contrast, those are assets, so that includes land, tangible movable property, or ideas, information, or techniques which have industrial, commercial, or other economic value. So that third category there catches trade secrets, plans and drawings, and also software programs, alongside various other things, but those are three examples. So you have qualifying entities, qualifying assets, and the next question is then what is a trigger event for each of those different categories? So in relation to a qualifying entity, a trigger event will occur if one of three tests is met. The first test is met where, as a result of the acquisition or the investment, the percentage of the shares or voting rights which the person holds in the entity increases from 25% or less to more than 25%, from 50% or less to more than 50%, or from less than 75% to 75% or more. So if you cross those thresholds, that would be a trigger event. The second test for a trigger event is met where the acquisition is of voting rights in the entity, which enable the person acquiring the rights to secure or prevent the passage of any class of resolution governing the affairs of the qualifying entity. The third test, thankfully slightly more simple, is whether the acquisition enables the acquirer to materially influence the policy of the entity. So those are the three trigger events which can occur in relation to qualifying entities. The position is again slightly more straightforward for qualifying assets. So that was your land and your movable property. A trigger event occurs in relation to a qualifying asset if a person acquires the ability to use the asset or to use it to a greater extent than they had prior to the acquisition, or secondly, if they acquire the ability to direct or control how the asset is used, or to direct or control how it's used to a greater extent than they had prior to the acquisition. So those are trigger events which can occur in relation to qualifying entities and to qualifying assets. If a trigger event does occur, or if arrangements are in progress which may give rise to a trigger event, and the Secretary of State reasonably believes that the trigger event may give rise to a risk to national security, then the Secretary of State may issue a notice to call in the transaction for review. The Secretary of State then has the power to impose remedies to address any potential risks to national security arising out of the transaction, and that could potentially include blocking the transaction or unwinding it in its entirety. To provide parties with a degree of certainty as to whether or not their transaction will be called in, the Act contains two mechanisms to assist with the identification of transactions which may be called in. Firstly, there's a mandatory notification procedure, and then there is a separate voluntary notification procedure. So firstly, just to quickly talk through the mandatory procedure. A mandatory notification requires parties to certain notifiable acquisitions to notify the Secretary of State of the acquisition and have it cleared by the Secretary of State before it can take place. So this is essentially a category of transactions which require the pre-approval of the Secretary of State before they can go through. A notifiable acquisition occurs, and there are two categories here. The first one is again when you cross any of those 25, 50, or 75% thresholds of shares or votes. And the second category is when you acquire voting rights to secure or prevent the passage of any class of resolution. The key point here is that those two tests only apply to certain qualifying entities, which have been set out in secondary legislation by the government. And those are entities which operate in any of 17 specified sectors of the economy. I'll save you having to listen to me list out all 17 sectors, but they cover various key sectors such as energy, communications, satellite and space technology, and also critical suppliers to government. So, think the things you would expect largely, but there is a full list of 17, so those are available in the regulations. Even if transactions are not within those 17 sectors and are therefore not subject to the mandatory notification procedure, the Act does include the option to make a voluntary notification where parties can voluntarily notify the Secretary of State of a trigger event in order to obtain a decision from the Secretary of State on whether or not the transaction will be called in for review. Once a notification is received by the Secretary of State, they must then decide within an initial 30 working day period to either clear the transaction or to exercise their call-in powers and review the transaction on the grounds that it may pose a risk to national security. So that was a whistle-stop tour through the NSIA regime. And the key next point for us is how does that actually impact on facility agreements and on financing transactions? And there are three main points which I would mention here. And the first may seem obvious, but where a financing involves the acquisition of a qualifying asset or a qualifying entity, consideration will have to be given to the NSI regime. You will need to think about whether the acquisition is subject to the mandatory notification requirement, or whether a voluntary notification should be made to provide certainty that the acquisition will not be called in by the Secretary of State. Lenders will want to avoid a situation where a financing completes and funds are drawn down by a borrower only for the acquisition which is being funded to then be called in by the Secretary of State. The second consideration, and this relates to a situation where a lender or a security agent is taking share security. We commonly see lenders take share security over shares in a borrower, for example. In that situation, there is a risk that on an enforcement scenario, if a lender were to enforce its security and to attempt to sell those shares, that disposal of shares could fall within the NSI regime. That could potentially lead to a delay in enforcing the security package, or in the worst case scenario, in the doomsday scenario, it could lead to the Secretary of State potentially restricting the disposal of the shares or imposing conditions on the disposal. An extra point to mention, and I'm speaking now only in relation to Scottish incorporated companies, when a lender takes perfected share security over a Scottish company, that process currently involves a full transfer of title to the shares to the lender or to the relevant security agent. That initial transfer of shares from shareholder to lender, which we usually see take place at completion or at financial close, does have the potential to be caught by the NSI regime. And that's something which lenders on these transactions should be aware of, particularly if the transaction relates to one of those 17 specified sectors which have been set out by government, because in that scenario, a notification to the Secretary of State would be required prior to any share security being perfected. So that concludes everything I was going to say on NSIA. As you can tell, it's a fairly complicated regime, but certainly something that should be kept in mind if your transaction has a national security angle, or if it is in one of those 17 sectors which I mentioned. Moving on now to the final regime which I was going to cover today, which is the Persons with Significant Control, or PSC regime. Unlike the previous two regimes which I've spoken about, the PSC regime is not really a new legal development. It's been in place since 2016, and it's now relatively well established. The PSC regime is a legal framework which was implemented across the UK to enhance transparency in relation to who actually exercises control over UK companies, and to combat money laundering and illicit financial activities. The regime was embedded into the Companies Act 2006 by the Small Business, Enterprise and Employment Act 2015, and it's also been supplemented by further regulations. So what does the PSC regime do? What are the obligations placed on companies by it? The PSC regime applies to all UK companies other than a company which has voting shares admitted to trading on a UK or EU regulated market, or a company which has voting shares admitted for trading on certain specified stock exchanges in Japan, Israel, Switzerland, and in the US. It's also subsequently been extended to cover limited liability partnerships, Scottish limited partnerships, and also certain categories of Scottish general partnership. From this point onwards, however, I will mainly speak to the position for companies. The read across to the other entities is fairly straightforward, but I will focus on companies from this point on. The obligations placed on companies under the regime can broadly be split into the following steps. So firstly, companies caught by the PSC regime must keep a register of people with significant control over the company. That register forms part of the statutory registers of the company, alongside your registered members, registered directors, and the register must contain the required particulars of two different categories. So firstly, registrable individuals with significant control, PSCs, and secondly, registrable relevant legal entities, RLEs. And I'll come back to those two acronyms. In terms of the other obligations, Companies caught by the PSC regime must investigate and identify any PSCs and RLEs, and then they must obtain and update certain information which they are required to hold on those PSCs and RLEs. And that is the information which is listed in the PSC register. And lastly, there is an obligation to keep this information up to date. There's a legal obligation on companies to update any relevant changes to information which they hold about PSCs or RLEs. So who requires to be listed in a PSC register? An individual will be a PSC in a company if it meets any of certain specified conditions. So firstly, if it holds directly or indirectly more than 25% of the shares or voting rights. Secondly, if it holds the right to appoint or remove a majority of the board of directors of a company. And thirdly, if it holds the right to exercise or actually exercises significant influence or control over the company. And lastly, and I just mentioned this for completeness very quickly, where the trustees of a trust or the members of a firm meet one or more of those conditions, and an individual has the right to exercise significant influence or control over that trust or firm, that individual will be a PSC and will be listed in a PSC register. So those are the fairly straightforward tests for how an individual can be a PSC. But as I mentioned, the PSC regime also provides that a legal entity which meets one of those tests and which is subject to its own disclosure requirements will be what's known as a relevant legal entity and will require registration in a PSC register. That test, which I mentioned of being subject to its own disclosure requirements, means that, for example, any other UK company which is required to keep a PSC register is capable of being listed as an RLE on the PSC register of a UK company which it controls. So that's, again, another very brief run through the PSC regime. And I'll just very quickly summarize. I'll talk about how that would impact on facility agreements and on financing transactions. So the PSC regime can have an impact on representations and undertakings found in facility agreements, particularly in relation to disclosure and compliance requirements. At a very basic level, as part of a facility agreement, a borrower will often represent and undertake that it is in compliance with laws and with regulations. A failure to comply with obligations under the PSC regime would, in theory, be a breach of those broad undertakings or representations. In addition, on some transactions, undertakings may be included in a facility agreement requiring the obligor entities to comply with any notices which are issued under the PSC regime and to provide copies of those notices to the lender or to the security agent. When a lender is taking share security as part of a transaction, we would usually expect the obligor entities to certify various matters relating to the PSC regime to the lender in a director certificate, and we would also expect them to certify a copy of their PSC register to the lender as a CP. And very briefly, one additional point which I should mention is the impact of the PSC regime on share security in Scotland. As I mentioned earlier, the share security process for Scottish companies involves a transfer of the shares to the lender or to the security agent. That also means that potentially a lender or a security agent will, subject to those tests which I've mentioned, potentially become an RLE and required to be listed in the PSC register of a Scottish company which it takes share security over. And that's by virtue of the fact that it would hold 25% or more of the shares in that company. And that, you might be glad to hear, brings me to the end of everything I was going to see on these three major transparency regimes. To very, very briefly circle back, firstly, we touched on the Register of Overseas Entities, which seeks to improve transparency in relation to the ownership of UK property by establishing the new Register of Overseas Entities. We have the NSIA regime, which increases government oversight and review powers in relation to qualifying entities and qualifying assets. And finally, we have the PSC regime, which requires certain UK entities to identify and maintain a register of their persons with significant control and any relevant legal entities. I will now hand you over to my colleague Matt, who's going to run through the principal frameworks underpinning green, social, and sustainability-linked loans.
Thanks, Tim. Hi, everyone. My name is Mateusz Minuczyc. As Peter mentioned in the introduction, I'm a solicitor in the banking team in our London office, and I'll be taking you through the principal frameworks underpinning green, social, and sustainability-linked loans. I will also highlight various requirements to be satisfied in connection with each of these forms of sustainable finance. So, changing values and expectations among businesses, shareholders, customers, and other stakeholders have pushed ESG considerations into the heart of corporate decision-making, investment strategy, and financial regulation. More so than ever before, companies are now being held to account for the environmental and social impact of their operations and the corporate governance standards and practices. It's expected that the value of global ESG-related assets under management will continue to grow at a compounded annual rate of 12.9% over the next 3 years. That means that by 2026, the value of these assets is expected to reach $33.9 trillion, accounting for 21.5% of the total value of global assets under management. This rapid growth in ESG-related assets has been enabled by matching growth in banks and other financial institutions funding development projects through ESG-related lending. The Loan Market Association has published data policy documents which aim to support and facilitate lending in 3 key ESG areas, and these are the green loans, sustainability-linked loans, and social loans. And as my colleagues have already mentioned, the purpose of this part of the webinar is to explore the LMA's green loan principles, social loan principles, and sustainability-linked loan principles, along with the related guidance documents. First question to ask yourself at the outset of your sustainable finance journey is, what is the purpose of the loan proceeds in terms of the sustainable initiative? And the reason for that is because the principal framework that's going to be used depends on the reason for which the loan is drawn. If the form of finance is going to be used to fund a specific project or a particular activity, you'll be looking at the use of proceeds-focused sustainable framework. And this includes the green loan and social loan principles. If, however, the funds are going to be applied towards a general corporate purpose, for example, to help a borrower improve its overall ESG profile, then you're going to be looking at the sustainability-linked loan. And in essence, there is a multitude of potential advantages to borrowers entering into ESG-related loans, ranging from the obvious positive impact on the environment to gaining access to new markets, a wider pool of investors, diversifying portfolios, and meeting regulatory or policy commitments. I hope to provide some clarity on the scope of these loans and the management of such transactions throughout this part of today's webinar. So firstly, we will look at green loans, and the green loan market aims to facilitate and support the key role that credit markets can play in financing progress towards environmental sustainability. The purpose of green loan principles is to promote the development of the green loan product by providing a recommended framework of market standards and guidelines for use across the green loan market, whilst allowing the loan product to retain its flexibility. To that end, the LMA defines green loans as any type of loan instruments or contingent facilities, such as bonding lines, guarantee lines, or letters of credit, made available exclusively to finance, refinance, or guarantee, in whole or in part, new or existing, eligible green projects, and which are aligned to the 4 core components of the green loan principles. This definition can be broken down into essentially 3 key components. And firstly, any type of bilateral or syndicated loan instrument may be a green loan, including a revolving credit facility. Secondly, in order for it to constitute a green loan, the loan product must be applied towards eligible green projects. Green loans can be used to refinance eligible projects or assets and the refinancing can occur before the loan being refinanced matures. Finally, a green loan must be in line with the 4 core components of the green loan principles, and it's recommended that borrowers formalise the alignment of these green loans with the components in a green loan framework or other legal documentation. So we will explore each of these aspects of the green loan definition in turn. Firstly, what is a green project and what are the 4 core components of the green loan principles? Well, green projects include assets, investments, and supporting expenditure. And one point to note from the outset is that there isn't an exclusive list of projects that are captured by this umbrella term. Instead, the LMA recognises broad, non-exhaustive categories of green loans, and these can include renewable energy, energy efficiency, pollution prevention and control, biodiversity conservation, green technologies, sustainable water and wastewater management, and green buildings. The LMA acknowledges that the meanings of green and green loans may vary depending on sector or geography, and ultimately eligibility depends on a project contributing to environmental objectives such as climate change mitigation or adaptation, natural resource conservation, biodiversity conservation, or pollution prevention and control. Turning to the 4 core components of the green loan principles. So these are use of proceeds, process for project evaluation and selection, management of proceeds, and reporting. The first core component, use of proceeds, requires the salient objective of a green loan to be the utilisation of the loan proceeds for green projects. And this needs to be appropriately described in the finance documents. The purpose of the proceeds must therefore be recorded by the borrower. The second core component, process for project evaluation and selection, requires the borrower to clearly communicate to the lender certain information. That information would typically include the environmental sustainability objectives of the relevant green project, the process by which the borrower determines how the project to be funded fits within the eligible green projects categories, and complementary information on the processes by which the borrower identifies and manages both perceived and actual environmental and social risks associated with the relevant projects. Borrowers are also encouraged to present the information communicated to lenders in the context of their overarching objectives, strategy, policy, and/or processes relating to the environmental sustainability. Where appropriate, borrowers should also explain how the relevant project aligns with the official or market-based taxonomies or related eligibility criteria, including, for instance, exclusion criteria, and disclose any green standards or certifications referenced in project selection. They are also encouraged to put processes in place to identify mitigants to known or potential material risks of negative social or environmental impacts from the relevant projects. They will not, however, and it's worth noting, be penalised for having exposure to controversial issues or sectors, and green loans can be made to a borrower with low ESG ratings, as the focus is on the eligible projects rather than the status of the borrower as such. The third core component of green loan principles, so management of proceeds, relates to process and transparency. The proceeds of a green loan should be credited to a dedicated account or otherwise tracked by the borrower in an appropriate manner. And that's to ensure transparency and promote the integrity of the product. Management of proceeds should be attested to by the borrower in a formal internal process that's linked to the borrower's lending and investment operations, specifically for green projects. Crucially, a facility can't be labelled as green if it includes both green and non-green tranches. The green label applies only to the tranches aligned with the 4 core components of the green loan principles, and these tranches must be clearly designated. The last core component of green loan principles, namely reporting, requires borrowers to produce and maintain readily available up-to-date information on the use of green loan proceeds. This information should be renewed annually until the green loan is fully drawn, or in the case of a revolving facility, until loan maturity, and on a timely basis in the event of material developments. The annual report should include a list of the relevant green projects against which green loan proceeds have been allocated, along with a brief description of the projects themselves, the amounts allocated to them, and their expected and achieved impact. Transparency is of particular importance here when communicating the expected and achieved impact of projects. Green loan principles recommend the use of qualitative performance indicators and, where feasible, quantitative performance measures. So, for example, these may include energy capacity, electricity generation, and the volume of greenhouse gas emissions, either reduced or avoided completely. Borrowers should also disclose key underlying methodologies and assumptions that underpin any such quantitative determination. So, to conclude this section, it is worth noting the LMA's recommendation that, where appropriate, borrowers appoint external reviewers to assess the alignment of their green loans or green loan programs with the 4 core components of the green loan principles. An external review can take the form of a second-party opinion assessing the alignment of the borrower's overall sustainable finance framework with the relevant principles. It can also be a verification focusing on the alignment of the loan with internal and external standards made by the borrower, or a loan rating measuring specific environmental performance data. Although self-certification may be sufficient in the case of borrowers with the requisite internal expertise, provisions for this process, whether it be external or internal, should be made in the legal documents agreed as part of any green loan. Okay, so having discussed green loans and each of the 4 components of the green loan principles, let's turn our focus to social loans. The concept of a social loan is very similar to that of a green loan, except that the requirement for proceeds to be used for green projects is substituted, perhaps unsurprisingly, with the requirement for proceeds to be used for so-called social projects. And the LMA defines a social loan as any type of a loan instrument made available exclusively to finance or refinance, again, either in whole or in part, new or existing eligible social projects. The purpose of the social loan principles is to promote the development of the social loan product by providing a recommended framework of market standards and guidelines for use across the social loan market, whilst allowing the loan product to retain its flexibility. Underpinning the social loan principles are the same 4 core components that underpin the green loan principles, albeit adapted for the social loan market and the concept of eligible social projects. The first core component, use of proceeds, requires that social loans be utilised by borrowers for social projects, including related and supporting expenditure such as research and development. Again, this should be clearly narrated in the finance documents. Social projects aim to address or mitigate specific social issues or seek to achieve positive social outcomes. A social issue may threaten, hinder, or damage the well-being of society or of a specific target population. As with the green projects, there isn't an exhaustive list of eligible social project categories. That said, eligible categories include providing or promoting affordable basic infrastructure, access to essential services, affordable housing, employment generation, or the alleviation of unemployment stemming from socioeconomic inequality, or food security and sustainable food systems. The LMA acknowledges that the definition of target population can vary, particularly depending on local contexts, and that in some cases, such target populations may also be served by addressing the general public. The second core component of the social loan principles is process for project evaluation and selection. Borrowers should clearly communicate to lenders the social objectives and target populations of social projects and how the intended application of loan proceeds fits within the eligible social project categories. As with the green loan principles, the social loan principles encourage borrowers to communicate the relevant information around eligibility criteria, context, and background, and to have a process in place to identify any potential negative environmental and social impacts. The third core component is management of proceeds. The proceeds of a social loan should be credited to a dedicated account or otherwise tracked by the borrower in an appropriate manner. And again, that's in order to maintain transparency and promote the integrity of the product. Management of proceeds should be attested to by the borrower in a formal internal process linked to the borrower's lending and investment operations for social projects. As with green loan principles, the fourth core component is reporting. Borrowers should keep up-to-date information on the use of proceeds. This information should be renewed annually until the social loan is fully drawn, or again, in the context of a revolving credit facility, until loan maturity, and on a timely basis in the event of any material developments. The annual report should include a list of social projects against which social loan proceeds have been allocated, and a brief descriptions of the projects themselves, the amounts allocated to them, the target populations, and the expected and achieved impact of each product. At the risk of repeating myself, this information only needs to be provided to the institutions participating in the social loan, and the LMA recommends the use of qualitative performance indicators and, where feasible, quantitative performance measures, which could include the number of beneficiaries from target populations. Finally, the LMA recommends that borrowers appoint external reviewers to assess the alignment of social loans with the four core components of social loan principles. Although self-certification may be sufficient, as is the case with the green loan principles, provisions for this process should be made in the legal documents agreed as part of every single social loan. So finally, we'll consider sustainability-linked loans. The key distinction between green loans and sustainability-linked loans is that there isn't a use of proceeds requirement for the latter. Indeed, many sustainability-linked loans are being advanced for general corporate purposes. Sustainability-linked loans incentivize borrowers to meet their sustainability commitments and reduce the environmental impact through environmental KPI targets, which are linked to the economic characteristics of the relevant loan. For instance, the margin may ratchet up or down depending on KPI performance. The purpose of a sustainability-linked loan principles is to promote the development of the sustainability-linked loan product by providing a recommended framework to articulate the fundamental characteristics of sustainability-linked loans. The sustainability-linked loan principles define such loans as any types of loan instruments or contingent facilities, again, bonding lines, guarantee lines, letters of credit, for which the economic characteristics can vary depending on whether the borrower achieves ambitious, material, and quantifiable predetermined sustainability performance objectives. Effectively, there are two key parts to this definition. Firstly, any type of loan instrument may be a sustainability-linked loan. Secondly, the economic characteristics are linked to ambitious, material, and quantifiable sustainability performance objectives. The LMA has set up 5 core components of sustainability-linked loan principles, which illustrates how this definition works in practice. These are a selection of KPIs, the calibration of sustainability performance targets, loan characteristics, reporting, and verification. And we will consider each of these in turn. In terms of the first core component, selection of KPIs, a sustainability-linked loan operates by aligning loan terms with the borrower's performance, which is measured using one or more sustainability KPIs. First and foremost, chosen KPIs must be material to the borrower's core sustainability and business strategy and address ESG challenges relevant to its industry. The credibility of the entire sustainability-linked loan market depends on this. It's therefore important to avoid the selection of KPIs that aren't credible. In essence, KPIs must be relevant, core, and material to the borrower's overall business, and it must be of high strategic significance to the borrower's current or future operations. They must also be measurable or quantifiable on a consistent methodological basis and able to be benchmarked, ideally using an external reference or definitions. A clear definition of KPIs should be provided by the borrower, which should include the applicable scope of parameters, the calculation methodology, and the definition of a baseline. KPIs should be benchmarked against an industry standard or industry peers where feasible. Second core component of sustainability-linked loan principles is calibration of sustainability performance targets. This crucial step determines the level of ambition to which the borrower is ready to commit. The SBTs, or to avoid the risk of death by acronyms, the sustainability performance targets must be set in good faith and remain relevant and ambitious throughout the term of the loan. It's therefore recommended that an annual SBT should be set per KPI for each year of the term of the sustainability-linked loan. In instances where a strong rationale is provided as to why this is not appropriate, exceptions to the annual frequency of sustainability performance targets can be agreed between borrowers and lenders. Borrowers should, where possible, also highlight any strategic information that may decisively impact the achievement of SBTs. The sustainability performance targets should be ambitious and represent a material improvement in the respective KPIs. They should exceed both a business as usual trajectory and regulatory required targets. Where possible, they should also be clearly benchmarked. Market participants recognize that SBTs should be based on recent performance levels and on a combination of benchmarking approaches. Those approaches could include the borrower's own performance over time, for which a minimum period of 3 years of measurable track record on the selected KPI is recommended. The borrower's peers, highlighting the relative positioning of sustainability performance targets as against its peers or as against industry or sector standards. And benchmarking with reference to science, for instance, to carbon budgets, official country, regional or international targets, recognize best available technologies or other proxies to determine relevant targets across ESG themes. Additionally, SBTs should be consistent with the borrower's overall sustainability strategy and progressed against a fixed timeline outlined before or during the term of the loan. Information provided to lenders with respect to target setting should include clear references to timelines for the target achievement and, where relevant, the verified baseline or science-based reference point selected for improvement of KPIs, as well as the rationale for that baseline or reference point and any circumstances leading to adjustments in baselines, KPIs, or sustainability performance targets. Reference should also be made to the way in which borrower intends to reach such SBTs, for example, by describing its ESG strategy, supporting ESG governance and investments, and its operating strategy, and other key factors beyond the borrower's direct control that may affect the achievement of sustainability performance targets. Appropriate KPIs and SBTs should be determined and set between the borrower and lender group for each transaction. It is recommended, again, where appropriate, of course, that borrowers seek input from an external party to ensure SBTs are sufficiently ambitious, material, and quantifiable. Post-completion, borrowers are encouraged to ask external reviewers to assess any changes to parameters, KPIs, and sustainability performance targets. In cases where no external input is sought, it's strongly recommended by the LMA that the borrower demonstrates or develops the internal expertise required to verify its methodologies. KPIs and sustainability performance targets, as well as mechanisms for review, should be carefully documented in the loan agreement. The third core component of sustainability-linked loan principles, so loan characteristics, requires that SBTs are linked to the economic terms of the sustainability-linked loan. For example, the margin under the relevant loan agreement will often be reduced where the borrower satisfies a predetermined SBT as measured by the predetermined KPIs and vice versa. In some cases where a strong rationale is provided, the ratchet may include a neutral bracket in which no margin adjustment applies. As mentioned previously, the fourth core component is reporting. Borrowers should provide lenders with up-to-date information sufficient to enable them to monitor KPI performance and determine the ongoing relevance and level of ambition of sustainability performance targets. An annual sustainability confirmation statement and verification report is also recommended. As transparency and accountability are essential to the operation and reputation of the sustainability-linked loan market, borrowers are encouraged to publicly report information relating to their SBTs. The LMA does, however, acknowledge that public reporting may not always be appropriate. The fifth, and you'll be pleased to hear, final core component, verification, requires borrowers to obtain independent external verification of the performance levels as against each sustainability performance target for each KPI for any period relevant for assessing the SBT performance, leading to a potential adjustment of the sustainability-linked loan economic characteristics. This verification should be conducted by a qualified external reviewer with the relevant expertise. These could include an auditor, an environmental consultant, or an independent ratings agency. Verification of performance as against sustainability performance targets must be shared with lenders in a timely manner and, where appropriate, be made publicly available. Once reporting has been completed and verification has taken place, lenders will evaluate the borrower's performance as against both SBTs and KPIs based on the information available. The role of a sustainability coordinator can be assumed by one or more of the lenders or arrangers at the outset of the transaction. And essentially, it involves providing commercial context regarding KPIs and sustainability performance targets for the borrower, and facilitating the ESG-related dialogue between the parties. As the lender who assumes this role does not assume any fiduciary duties to the rest of the syndicate, each lender must satisfy itself with the borrower's KPIs, SBTs, and any other credentials. Right, so finally, it's important to have regards to the regulatory environment. Sustainability-linked loans are the most complex of the three loan products we have considered so far, and therefore attract the highest degree of regulatory scrutiny. The FCA published a short review of the sustainability-linked loans market, which effectively concluded that the market is not currently achieving its potential. It also identified concerns around credibility, market integrity, and greenwashing, as well as conflicts of interest and weak incentives to participate in sustainability-linked loans. However, the FCA acknowledged that the sustainability-linked loan market was, at least at the time of writing, in its infancy stage, and pointed to the LMA's sustainability-linked loan principles as a very welcome development, which should help to address the issues identified. We understand that the FCA will continue to monitor the market, considering whether further measures may be required to support the market as it matures. Okay, so that was everything I was intending to cover. Thank you very much for staying with us, and I will now hand over to Peter, who I believe has received some questions from the audience. Thank you.
Thanks, Matt, and thanks to everyone who has submitted a question. Unfortunately, time has slightly run away from us today, so we will respond to those questions that have been submitted after the webinar by getting back to you by email. Please do, though, if you have a question, send it in now, and we'll, as I say, answer any unanswered questions. It really just remains for me to say thanks very much for joining today's webinar. There is some interest in the Q&A in any supporting written materials or slides that we might have, and we'll be very happy to share our client briefings on these topics with those who've attended the webinar. So keep an eye on your inbox in the next couple of weeks, and you can expect to receive some client briefings on these topics. If you would like to follow up with Tim, Matt, or me on any of the issues we've been considering today, then please do. We'll be very happy to hear from you, and our contact details are available on the website. We hope to see you at our next installment in our ESG webinar series. But until then, thanks very much for joining, and goodbye.